I loved the idea of dividend blue chip stocks for stability. At 30 years old, I had 2 TIAs. The most important part of life are people. It's the relationships that we build, the memories we build with them.
Hello, everyone, and welcome back to Moementum Finance channel. Today, I'm super honored and excited to be welcoming the one and only Mr. Financial. Welcome to the show, sir.
Hey, thank you so much, Mo, for having me on. It's really my honor. I know we've just been talking for like the past 20 minutes, but it is an honor to be hosted by someone like you that has put out so much content on social media, and you're looking at me who doesn't really know much about social media.
You're super humble, and honestly, Mr. Financial, you're one of those content creators that I followed for a long time, for a very long time, and always loved your portfolio updates, the energy that comes through them, the amount of effort that goes behind the scene to make those video portfolio updates so polished, just top notch. Amazing work to you and your partner. You're doing a fantastic job. Later on, found out that you're actually one of the Blossom ambassadors, and just before we hit the record, we were talking that you are one of the very early Blossom users too. With that all said though, for those who may not know you as well, why don't you give a quick introduction of who you are and tell us a little bit more about your background and your journey that led to this point?
Yep. So I'm Mr. Financial. I live in Vancouver with my wife. I have a background educationally in sports science. I ran my own business in that industry. I've dabbled in real estate investing, day trading. I've been in the stock market for 21 years.
Wow.
And then during COVID, that's what really kickstarted the whole YouTube thing. Like I was mentioning earlier, I wanted to track at least one account where I could have accountability to myself and to my thought process of why I was making certain additions or certain divestments of my portfolio. And somehow, out of nowhere, I've ended up with, 100,000 followers now on Blossom Social. And as I said, I'm not into social media. I'm still trying to figure it out. I really don't know how it works. But that's pretty much who I am and where I've come from.
Your posts are always thoughtful. Even on Blossom, every time that you post content, whether it's the YouTube post or even chiming in on their posts, always have that respect and trying to really think about how can you add value to the audience. I heard have invested in the stock market for over 20 years. That's just so incredible. But let's go back, take a step back and talk a little bit about your upbringing. I know you've been vulnerable as well on Blossom. Talk a little bit about your upbringing or the journey that it took you to get to where you are, and even sharing as much as early on growing up, hearing your parents stressed out about money. Obviously that can definitely impact how you see money, how you see the world of finances around you. How has that actually shaped who you are and your drive for financial independence?
Well, I'm pretty old now. So, of course, that was a long time ago. My parents are doing much better now. They're not stressed about finance. But as you said, they were struggling in their early years. So watching that growing up and not having much as a young person really made me not want to have to struggle through life just to survive. And I also didn't want to have that poor man's mentality that can sometimes come of it. And so I had to work really hard. It did shape me to wanting to be smart about my money. So I would say if there's one big takeaway or something that's really shaped me from this experience is that it taught me to be a value spender. We talk always about value investing, but I think value spending is something that has really, from my youth until now, has kept with me. It's really driven my financial independence movement.
Can you give me a concrete example of value spending? Give us one example.
Yeah, I can give you a really basic one. I've moved, as I was mentioning earlier, to a cheaper area of my city where I can still live a high quality life, short commute time. I get everything that I need, but at a very much reduced cost. So I feel that I'm putting each dollar to its very best use. Just like I would want to invest to get the most shares, I want the most of my money.
Great example. Early on in your story, you had previously shared on Blossom, Mr. Financial, that you did a variety of, I think, tasks and roles. Early on, at 12, you were a paperboy. As you talked on the onset of the call as well, you became a real estate investor early on, apparently at your 20s. That's just phenomenal journey to where you are today. What were some of those pivotal moments early on in your journey that when you reflect back and look back at it, actually shaped your ability to be able to reach to the level that you are today?
That's a loaded question. Of course, there's so much involved with life. 21 years I've been at it. I'm 40 now. So I have always been familiar with investing in general, just because my mom was a real estate agent at one time. and she's invested in real estate. My dad's owned businesses, even some that have failed. That taught me a lot. I have relatives that have worked in Wall Street and currently work in Wall Street. My grandfather was an investor, did very well for himself. But I would say something that I spoke to even my wife about, like previously, was a book that I read before I was a teenager, and it had to do with compound interest. And in that book, there was an example. Would you rather have $1 million today or a penny that doubles for a month? And that just blew my mind as someone who was young, and I love math and just learning about compounding. And, it was so impactful for me, and in prepping for this interview as well. And I've been so interested in business, math, finances. I use it as a Blossom social post. I've used it in a video. That's how much that book has really impacted the way I view finances and the idea of compounding, how it affects my investments, and also how it invests my spending. And I would say I think going back to that value first spender, like I'm a value spender, that also works with compounding, because we always talk about the compounding effects of our investments and when it comes to finances, but we never talk about the compounding that happens in inflation or the compounding that we do to ourselves, like going from a 1-bedroom apartment to a 5,000 square foot home. That will compound our expenses. I hope that answered your question.
That answers very well. Yeah. So even that, like some of those reflections essentially, and as a result of that, making those deliberate decisions really helped you to set you up to getting to the level that you are, right? So you had to be very strategic around how you spend, to go about your money, managing your money. You did mention that at some point you even started and were a day trader. Is that correct, Mr. Financial?
Yeah. Again, this has to do with who helped me get into the markets. I have a relative that's double PhD, has worked in Wall Street for a number of years, has done very well for himself. And so he's kind of the one who pushed me into the markets. And of course, as a young person, you love high risk, high reward, right?
Yeah, it's common these days. And then what made the switch for you to go from being almost a trader or starting as a trader to now, I believe your style is more on a dividend growth investing. Is that fair to say?
Yeah, I was a dividend growth investor for a long time. I believe life isn't just linear. There's different seasons. We have our winter seasons and our summer seasons. So with each new season in life, it kind of requires a different strategy. So, day trader is a single guy, high risk, high reward. I had time, I had money, very different when I got married. So that was a new season of life for me. And, having the love of my life with me, wanting to do things together, not wanting to blow up a portfolio that you worked hard for, really changed how I viewed risk. And it brought me to a very new risk tolerance. That's when I started looking a lot more at my risk capacity, at my risk tolerance. And so wanting less risk forced me to really cut down on the amount of trading I did, whether it was day trading or just trading in general, just high frequency portfolio turnover. And so that led me into dividend growth investing. And you're probably thinking, like, why stock picking? Stock picking is so risky. Is that what you're thinking right now, Mo?
Yeah, I was going there.
Yeah. So I liked the dividend growth strategy because I was already so familiar with growth investing in general, how to value stocks. And then I loved the idea of dividend blue chip stocks for stability. So then mashing those two together gave me kind of the best of both worlds. And I also really liked dividend growth investing because there were some specific metrics that only dividend stocks allow you to have to help evaluate what a possible reversion to the mean could look like. For example, I love giving examples. Cut me off if you need to. I talk too much sometimes. We can look at like 5, 10, 20-year historical yields and compare it to the yield right now. We could also use dividend growth rates, what they were currently, what they were last quarter, what they were like 5, 10 years ago. If they're slowing down, increasing, are they stable? We can look at historical payout ratios by earnings or DE, distributable earnings. There's all these different things that you could screen for that are unique to dividend growth stocks, which again, it is inherently still high risk because you're cutting out about 50% of the market. Since at least internationally, it's maybe a little higher. In Canada, we have a little bit more dividend growth stocks in the market. But when it comes to the US, which makes up about 70% of the market right now, they're much smaller. So it did increase, you say, concentration risk, but there were some things that I liked that I could use to help understand also the business dividend growth stocks are usually in very specific industries, in specific sectors. And it was a little easier to understand the total addressable market for a lot of these type of companies, as opposed to something that is very speculative, like just a pure growth stock, where you don't really know what's happening. Like just one thing that I would do, I would make sure that something had a 5-year dividend growth history. And that was just one way that, okay, not only has this company been around for X amount of years, but then now they have a 5-year dividend growth history. That's just, again, another example of these little metrics that I would like to use, as opposed to like a dividend growth stock. The stock's been around for 5 quarters.
So
Are
you
you
look
going to
at
jump in? For
multitude
me,
of,
that was way too
yeah.
high risk.
Yeah. And then once you landed on it and obviously doing your due diligence on through a variety of metrics to pick those dividend growth stocks, since then, have you maintained that same approach, or has that approach evolved a little bit to possibly include maybe stocks or ETFs that may not be paying a dividend? Has that changed, or no, that's not been the case at all?
So I've had ETFs as part of my portfolio as like you can say like a core position, because we have RRSPs, we have taxable accounts, we have TFSAs as part of a core position in my portfolios for quite some time. However, a new season in my life is coming, and so I had to make changes again. And I can say right now, I wouldn't call myself a traditional dividend growth investor, unless you consider yourself, Mo, a dividend growth investor. Then I am too.
Yeah. Okay. So is that fair to say, reading between the lines, would you consider yourself a little bit more now tilted towards ETF, low-cost ETF investing? Is that fair to say, or not necessarily?
I own zero. Only a few people on Blossom probably know when we've had chats. I have 0 stocks on my portfolio right now.
Okay. So
I need to update my
full transition out
Blossom
of it
portfolio.
then.
100% transition. I am a broad index investor.
Okay. Yeah, that's because that's
right
the
now.
sense I got from you. And then now, as in preparation for the interview questions, like, oh, dividend growth investing. Like, I didn't get that vibe earlier on. So it seems like obviously you've made that transition. How does that feel? Because obviously you've invested for many probably years in dividend growth. Was that a big transition for you? Do you sleep better at night? Do you think it has to do with the seasons of life?
It does have to do with the seasons of life. If I could go back in time, and it's funny, we're probably going to discuss this again. If I could go back in time, I wish I can buy back all the time I've spent in the markets, because I literally lived in them when I was younger. And even recently, even during COVID, I'm always reading financial reports. I'm always keeping up with my portfolio. I feel like I live in the stock market sometimes, especially when things get really hectic. Like right now, the market has a lot of volatility. I would have to normally be very closely monitoring my positions, maybe inputting new stop losses to preserve some of my gains, or if I feel that a certain position might be quite vulnerable to a huge drop. I don't need to do that anymore. I really couldn't care less what's happening right now. It doesn't impact me. I'm 100% equities. I'm going to be broad market indexing for the rest of my life. So yeah, no, I wouldn't say I sleep better. I slept pretty good before too. But I do have a lot more free time now, and I don't have to be thinking about the markets or worried about them. So worried that I need to actually know what's going on.
Knowing what you know now, if you were to give advice to a 20-year-old yourself, would you have told yourself to change anything back then, or just go index investing or low cost diversified investing? Or do you think that had its time and it was already the right call? Or maybe they're not necessarily a perfect answer here either, and that's okay too.
It was a little challenging because I started in 04. ETFs in Canada, like I didn't really see a lot of them pop up till like 2013, 2014. So it would have been a little challenging. It would have to have been mainly in like the US market. But yes, if I could go back in time, I would have been like, go buy VU or SPY, make it 70% of your portfolio, and maybe add some other satellites to it and call it a day. Never look at the markets. Every paycheck, keep adding money, Mr. Financial, and you'll be fine.
Yeah, for sure. I know, Mr. Financial, you did mention in one of your posts from a lens of vulnerability that both yourself as well as your wife had some health challenges, and really use that opportunity to reflect on the importance of health, right? Wealth is great, but it's not much valuable if you don't have your health. How did those life experiences actually shift your priorities around work, money, and time?
At 30 years old, I had 2 TIAs. So that completely shook my world, changed my life outlook. And I think most people learn that lesson much later in life when they have, on average, a life-changing event like that. So I used to think, like probably most young men, I'm invincible, I'm never going to get old, I have all the time in the world. And so what this event taught me, and I've had other health events since then, is that the most important part of life are people. It's the relationships that we build, the memories we build with them. And I want to keep being able to put time and energy into those relationships that I have. And I'm pretty sure I can assure you, Mo, that there's not one person on earth that is sitting on their deathbed regretting, I wish I worked one more shift of OT, or I wish I had bought that new $20,000 painting. They wish they could have spent more time with their grandkids, with their kids, with their mate, with their friends, with their parents, with their aunts, with their uncles. People. Making memories with people, I would say, is the most important thing. And that's the biggest, I could say, side effect that came from that.
Super powerful.
And if you want to link it to money, because this is, we are talking about finances here, spending money wisely then and investing allows me to have time and energy for what I believe is most important without having to jeopardize my health. Because, people need time and energy, and health gives you the energy to be able to give to people. And that's one of the reasons why I started working part-time about 6 years ago. It's been the best decision I've ever made for myself.
That's incredible. That's amazing. I think, Mr. Financial, correct me if I'm wrong, but I remember one of the questions that I had potentially in preparing for this interview was that you had talked about it because of the importance of relationship and whatnot. How is also generosity is also an important aspect of your life. Is that correct? Sorry, I might have read that somewhere. And then like how you use the time, you take the time to maybe celebrate different accomplishments with family and friends, and how you're generous when it comes to spending time with them. Do you mind sharing a little bit more about that?
Yeah, again, this goes back to what life is about. There's no point of making a huge portfolio if all it's a number on a screen and you don't use that for the good of those that you love around you. And so when it comes to being hospitable, sometimes we worry about how much time or how much money we have. Some things are super cheap and they make all the difference. Like, how expensive is it to make a delicious cup of coffee, even if you don't have a fancy machine? I love my coffee. I'm a coffee man, but still, beautiful cup of coffee, a homemade dessert, or even if you buy it from a place, $5-10, you can make a gorgeous meal for $30 and spend an evening, a memorable evening with friends or with family. And I think that is like one of the great benefits of investing, is that you actually end up having more that you can use for friends and family to be hospitable towards them and others.
And those memories, even after the fact, like, stay with you for years to come. You reflect back, remember that time when we came together and we had a good chat and whatnot. It's actually relive those moments a lot. And essentially the memory dividends, I think the term that we hear from a book, right? So that's just incredible. You've been with Blossom from early on, right, Mr. Financial? Obviously, you've seen how the platform has grown, how maybe the early plans that the platform had to where it is today, over 500,000 users, just so incredible how far and how fast the platform has grown. What type of role do you see for folks, whether they are ambassadors or even an average user on Blossom, content creators on there, to use this platform to help each other grow and essentially spread right information, as opposed to like maybe something that may be more detrimental? What roles do you see for them?
Yeah, like I mentioned before, I didn't use social media a lot until I started YouTube, and Blossom Social is pretty much the only social platform I have. My wife created an Instagram account for me, but I don't even have access to it. I don't know the login. I don't have TikTok. But when I looked even what's happening on YouTube and on Blossom, the viral inaccurate content, it actually shocked me. I didn't realize how quick and how easy it was for you. Sometimes it's innocent inaccuracies, but even sometimes it's coming from places like marketers who will portray information in a way that is inaccurate, and they will use content creators to do it. I was dumbfounded, and how viral and how quickly inaccurate information, and sometimes pure outright falsehoods, can become truth because they've been spread and circulated so often. And like we hear it all the time, if you hear a lie enough, it becomes your truth. And so how can we as content creators, I don't like to consider myself a content creator, but I am. I guess I record myself on YouTube now showing my face. I think the most important thing we can do is teach principles, and teach especially the younger generation that isn't used to using critical thinking and how to analyze, how to research information, going back to basics, learning the fundamentals of finances. Because like with sports, I don't know if you play. Do you play a sport, Mo?
No.
No? Okay. I loved football, like, football with your feet. I played a lot of basketball growing up. And when you play basketball, you always get hammered into you. It's all about the fundamentals. Learn the fundamentals, and then the whole game comes off of the fundamentals. You can't start learning a 360 dunk before you know how to dribble. So the same applies to finances. Once you understand all the basics, and there is a lot involved, like taxes come into play. We talked about compound interest. How many people don't know about compound interest that are investing in the market is mind blowing. I hear it all the time. How many people who don't understand what an earnings report is and they're investing in individual stocks? It's mind blowing.
Yeah.
So once you learn all these basics, when a piece of false information comes at you, you can see it right away. It's contradictory to all the principles, the foundation that I have. This cannot be true. Let me investigate why it's not true. As opposed to someone, when you don't have that foundation, you haven't built, and especially as content creators, we're not encouraging a good, strong foundation. It's really easy to get deceived. And I like to put it that way, that there are some innocently who have been deceived into thinking that there's magic out there, that the markets can magically make money grow on trees and you can snap your fingers and overnight you retire because of some product that only if certain people know about it and other people are against it. So a platform like Blossom Social, I think, is great if it is used responsibly. And if as content creators, not only calling out, I think I have a responsibility, and I think you do too as well, Mo, to putting out accurate information, using empirical data, using research, not just sharing my thoughts or my ideas, because likely they're wrong. I know that from looking back at all my experience, likely my ideas on the market are going to be wrong. And if they were right, it's a fluke. I'll say it out loud. Even my prior investing, majority of it was probably just due to timing. My investing career started at a really good time. Most of us on Blossom, I should say, started at a really good time in the market. And so going back to that, if we see inaccuracies, like I personally like to call it out. Because I feel that if I don't, I'm allowing that person to continue down a path that could harm them. It could harm them, those that are around them that they share this information with. And especially because what Blossom Social turns into is basically an echo chamber. Because you'll see it a lot of times. If one idea is presented, soon in another comment, someone is presenting that same idea thinking that this is a truth or this is a financial principle that we can apply. So that's something that I think we can do to better educate as opposed rather to influence. Buy this stock, do this strategy. It's like, well, why is this strategy right? What's the fundamental reasons? Because again, you can't, like, how you use principles, that's up to you. But knowing those principles is what's going to allow you to be able to make an educated decision for yourself that's going to lead to the best success according to your circumstances. I do like to pipe in to conversations if there is inaccuracies. I will make a comment stating, again, like I said, financial principles, the fundamentals. And I also make posts that can be taken as controversial topics. But to me, it's like stating 1 + 1 is 2. For someone who believes it's 3, it might be considered controversial and you're trying to pick a fight or an argument. But to me, I'm just trying to help people learn addition, that 1 + 1 = 2. And that this also, maybe you learn that 1 + 1 + 1 = 3. Now you can count and you can use this information however you see fit. So I hope that's how on Blossom, and especially YouTube is a different platform, but still, especially Blossom Social and on YouTube, I hope it's been taken as constructive, that it helps better people. And I'm not a professional. I've had like very minor professional training, but I don't hold any credentials of any sort. And I hope that whatever I have shared has never been detrimental to someone, because that's, again, a reason why I think it's so important for us as content creators to be very accurate with the information we give and really research and know the backing behind why what we're saying is either true or not true. And that's why I, like, recently as well, I'm adding a lot of studies to my videos to show that this isn't just something I'm pulling or I saw this or I heard this, because when we have gaps in our knowledge, we just won't know what we don't know. You always hear that saying, but it's really easy to be misinformed when you don't have a foundation, when you don't have those fundamentals, as I was saying earlier. So I'm hoping, again, that all this content that I'm putting out is not taken as confrontational. I'm also not someone who likes confrontation. I just feel really bad for anyone that is being misled and has been led to believe something. And this happens for growth investors too. There's penny stock pushers, there's micro cap pushers, there's, special sector pushers. You see it. Social media is full of it. And I'm like blown away by how much of this there is. And you'll see companies being sponsored in videos that are super high risk, that are being encouraged for young investors and old investors to be investing. And again, so for this, it's not to be controversial. I just feel for these ones. And I think if this poor fellow neighbor of mine loses his ability to retire comfortably because of misinformation, and I could have stopped it, I have to speak up. And so that's why I like to put out factual information like that, not to be controversial.
Yeah, no, I totally agree with you. As you're saying, Mr. Financial Dad, though, I keep thinking about like somebody like Ben Felix, right? Do we agree that he is a lot of his pretty much almost every single video that he makes very much factual, evidence-based? He tries to take the emotions out of it. Like he tries to come across as like, facts. This is facts. Facts are facts. Sure, he has a little bit of his own take on it. He's a human after all, right? So he might think he's how he feels about the topic, but at the end of the day, he tries to bring it up from a factual lens. But even that, like for example, for a topic like a covered call, and he's made definitely most recently a lot more videos on that, and even going as far as calling it the financial bullshit as an example, right? A lot of people didn't take that the way that maybe as like, oh, he's just trying to educate me. Like there were definitely some people that took it totally the other way, like, how dare you even comment on that? My thought sometimes is that I think it's great, of course, like, somebody like Ben Felix, yourself, like trying to educate Carr, others, Levi, right? Really trying to put factual information. Do you agree that there has to be that acceptance and appetite to being challenged? Because if no matter how great of a job, sometimes if we do, if there is not that openness, it still make an impact. But if there's not that openness, you're not going to make that change on that person. Like they have to be open to be willing to listen. And at the end of the day, I guess our role is trying to educate. Right?
It's definitely not easy. And there's both sides, right? There are certain people that have a preponderancy to just follow the thing that they hear. And so certain individuals, the first thing they heard is what they're going to run with. So if the first thing they hear is, penny stocks are going to get you rich, they run with that for a while, or, cover call ETFs. And so the goal is hopefully it's open conversation. That's why when you put out content that is factual, not degrading anyone, and that's something that I try to be I try to respect all people's views. At the end of the day, your portfolio is your portfolio, and what you do with your money is what you do with your money. But you as a person, you're still my fellow human. I want to treat you with respect and honor as a person. And so I hope that's how it always comes across when we have these conversations, especially on Blossom. It's hard with text. You don't see emotion. I try to put in my emojis. I have a lot of facial expressions. I use my hands a lot. I guess I'm too Italian. I speak too much. I'm too long-winded. But the goal is always to have those conversations that can lead to openness, that can get people to think and want to learn. I make a lot of posts actually about learning, being an active learner, because it's one of the biggest things that you need to do as an investor. Unless you're going to broad market index and forget it and not watch the markets, you need to be someone who is willing to be actively learning about tax implementation, strategy, just everything in general, especially if you're investing in individual stocks or unique strategies. You have to be a learner.
We talked about covered call definitely here a little bit. Is there any scenario where you see maybe a fund that has covered call strategy in it, income generating approach to it, suitable for some investors from your perspectives?
So this is going to be very controversial as a topic. I know it is. This is going to be great for your engagement. I write options, calls, puts. So I already do that in my portfolio. And there is a place for options. It can be used for many reasons, right? Some people use it as hedging. Other people use it as leverage. Some people use it to lower the volatility of their portfolio slightly by writing, calls or even puts on with their cash. There's a lot you can do with options. However, when it comes to covered call products, I'll call them products. I don't like to call them ETFs anymore. They're like products because it goes down to sometimes a single stock.
Yeah, that's true.
To me, that defeats the whole purpose. And so when it comes to single stock ETFs or these ETFs that have leverage, that are using covered calls, there is nobody on earth who should be touching these. And that's why, again, I'm very outspoken about it. I'm not really as much outspoken towards people who push them as I'm very outspoken about the providers. I'm actually shocked sometimes. I get advertisements for these. You can get 25% yield. And I'm like, why does that matter? It's not, that's like saying a house can be as big as you want it to be. Like, that means nothing. Like, you can say it's 3,000% yield. It doesn't matter what the distribution yield is. And so going back to that, do I think anyone could use a covered call ETF effectively? No. Unfortunately, the market we live in and the products that are available right now, they are very high risk. And when I mean very high risk, like you can go in and look at the product sheets for a lot of these products and it's labeled as high risk. And who do they advertise to? Retirees, people who want income, who should be having lower volatility. They give themselves a very high volatile product. Because when they say risk, usually it's on product sheets, it has to do with volatility. So we're talking about huge up and downs. And we can see this all the time. So yeah, my stance is there is no one who should be building a portfolio based off of just a covered call product. And especially if you're new, if you're investing in individual stocks, that's already risky. Now you're investing, a lot of the products have leverage, that's extra risky. And a lot of all these products are selling calls, which is basically trading. So they're trading products, which has another level of risk to it. And for people that are in accumulation phase, there's also tax consequences that a lot of people are completely unaware of that they're doing. So yes, do I believe these products are good for someone? No, I cannot see it being used unless it's like for like 2 weeks because they believe and they have a certain belief and a small portion of your portfolio is in something very general and broad. I have seen though, I should say, BMO does have some very, very conservative covered call products, ETFs on, say, for example, it's on the Dow or something, and it does the job it's supposed to. It lowers your total return slightly, and it also lowered the volatility slightly, but it's not going to do any magic. It's not meant to do any magic wealth gain or anything like that. And no one would be interested in it because they have like a 5% or 6% yield.
I feel like sometimes these new products that are being presented left and right almost capitalize on the psychology of money in a way, like how behaviorally a lot of folks that are young or those who are even sometimes seasoned, even have been around for a while, love that feeling of, well, I get paid.
That's the power of social influence. And that's why, again, I think we need to talk a lot about it. And a lot of the people who promote, whether it's on YouTube or Blossom, some of these strategies, whether it's single stock or even if it's an index covered call ETF, a lot of them don't understand how options work at their basic mechanical level. And I think that's the biggest challenge because like a lot of people talk about income, but they don't understand when you sell a call or even let's use what I just made a video on, NVIDIA. When you have a portfolio that is being sold, 50% of it covered by a covered call, what happens when that call is negative? What I mean by that, like, let's just give a real life scenario. Right now, NVIDIA is trading at around $190. Imagine you sell a call at the money and say you get a great premium for it. Say it's like $10. What happens when it comes near expiry and the stock is trading at 210? You've made $10, so technically you made up to $200. The manager of that fund has to do something. And no one talks about this. No one understands this. They just think we got income. It's like, but did you really get income? It's only half the trade. You still have to complete the trade. So what's that manager going to do? Let half of the shares. So now they lost half of their shares because half the portfolio is covered. And now they only have, instead of 500,000 shares of NVIDIA, they only have 250,000. Do they let them all get called away and hope the price goes down before they buy them back? And stay in cash. Now 50% of their portfolio is cash. What do they need to do? Usually they have to pay a huge price to buy back that contract. No one talks about this. No one knows about this. Because again, if you don't know what you don't know, they just see yield, they just see distribution rate. They don't even know where these distributions are coming from. They don't read the financial statements from these ETF providers. And so this is, again, like I said, it's really easy to post a number. I earned this much. But usually you don't know how much they've invested in the product, at what price, for what duration they've owned that product, and what their total return is. Because again, going back to that example of NVIDIA, I'm sure everyone here would feel really bad to know that I'm selling calls on a product, but this ETF covered call layer is actually costing me lots of money. You probably would be like, I don't want to be in this product if it's actually costing me so much money to be running this. And let's not talk about the 50 basis point MERs. Then there's the trading expense ratios that are very high, and it goes on and on and on. There's so many negatives that come with it. And again, if you don't know, you just see a yield percent and you think yield equals return. This is again why we have to go back to basics, go back to the fundamentals of investing. Such a common thing. There's videos, there was a comment about it, NAV erosion. It's not a technical term, but when you have a fund whose NAV keeps going down, who would invest in UT if every time you opened up your account, you saw that it's now $38, $37, $35. 2 years later, it's $20. Would you keep putting money into that fund? It logically doesn't make sense. So even understanding where your distribution is coming from, it's coming from the fund. Because XEQT, it has a distribution too. It's just 2% or somewhere at 1.8%. No difference. So yeah, so going back to that idea, covered calls, who can it be used for, what we see, how we can talk about it. It all goes back to the basics. It really does. On Blossom Social or on YouTube, if anyone that's going to see this video, I hope they start to think about what basics do I need to learn and start learning it.
And where do you think of some of those folks who are intrigued, like, I got to do my research, I got to learn? Where can they learn some of those notions, fundamentals?
So this is where knowing where to go to for information is so critical. Obviously, there are some big institutions that teach the basics, but even a lot of the big banks in Canada and the big banks in the US, they provide material that teach you all of the basics. You'll be amazed how many times when I'm preparing a video and I'm thinking, what could be a good resource for this? And I go, oh, do you know what? Actually, when I was on TD the other day, I saw, and I'm like, oh yeah, they have a great resource. Or when I was looking at Citibank, and so I use a lot of the big banks, another place you can go to are some of the research firms like MSCI you can use, S&P, so Standard & Poor. They make a lot of research material and teach you a lot about some very, very fundamental basics. Again, going back, I don't mean to hammer on the covered call, folks, but the magic that somehow investing in this product makes you either retire earlier or retire richer or be able to have whatever distribution is going to be your retirement. If it's a 40% distribution, you can have 40% of your fund is now your yearly amount you can spend. Something as simple as just going to S&P Global and typing in withdrawal strategy. And you can read all about it. You can read study after study if you wanted to. They can go to the basics. You can even go to TD. TD Bank has it. Type in withdrawal strategy. They'll talk about the 4% rule. Of course, it's not a rule. And they'll teach you the fundamentals of how it works, of why 4% index to inflation is reasonable over a long duration of time. And again, this is something that I think all of us have the ability to do. It's amazing we have the internet, and sometimes it's used very poorly by watching what others who also don't know tell us.
Got to have that drive as well to take the time to educate. Unfortunately, sometimes folks who are, let's say, brand new, and maybe not only them, but we just want easy answers. Hey, I have $1,000. I want to invest. What should I buy? And they expect somebody else coming in the internet and telling them what to buy. And then you see, of course, going through the comments, a gazillion range of, you have anything from covered calls to ETFs to all-in-one, of course, and none of them may necessarily, none of them, a lot of them may not be wrong, because each one of them, they're looking at it from their own set of perspectives, what maybe works for them. Doesn't necessarily mean that's wrong or right, but it may not be the case for the person. And I get it, for somebody who's brand new, who doesn't know what to do, of course, it can be overwhelming and they need some level of help. But at the end of the day, I think you got to also put in the time to educate yourself. To your point, at least learn the fundamentals, and then from there onwards, maybe you start baby steps, you gradually learn your way. And as you know more, you're going to hopefully make a lot more better decisions that are better suitable for your circumstance, to your point, risk tolerance, what your goals are, time horizon, and all of that. Speaking of time horizon and knowing your stuff, as you're approaching a little bit closer to the financial independence, how has your consideration, finances, and life strategies changed when it comes to money and finances?
Well, besides, like I mentioned, my strategy changed. I'd say that's definitely something that I've had to take into consideration because my tax situation is going to be changing. And the dividend growth strategy, another big reason why I was a dividend growth investor was because of the tax code in Canada. It is very favorable towards eligible dividends. Like, just as an example, I don't remember the exact numbers. Don't quote me exactly on this, but for about $85,000 of eligible dividend income, in my province, BC, I would pay zero taxes. So between my wife and I, we can have $170,000 of income and pay zero taxes. Whereas if our retirement were constructed in a different way of interest or other income, we would have to pay probably about $35,000 on that same amount. And if it was capital gains, which are much better, it would still be about $10,000. That's a substantial amount, especially if you're going to be doing it for 30 years, compounding. Knowing that I'm going to be, as I'm moving towards financial independence, I do not want to have a tax drag on my accounts. This has really come into play. So for myself, that's another reason why I've gone the broad market indexer way. I really want to have the smallest payout I can possibly have, because the jurisdiction I'm going to be in for taxes soon, it taxes capital gains equally as it does dividends, as it does interest. So there's really no benefit of having of using tax strategies to your advantage. The only thing I want is I want to keep as much of the money within the fund compounding internally so that there's no tax drag on my account. Because if I look back and I see how much I used to trade, I'm like, oh, I paid so much taxes for no reason. Like sometimes you don't think about it, and you're like, oh, I can get a quick, this is a quick 20% gain. And then when you think about it, you have to calculate the taxes on that. And then, another 10% gain. If I just held that stock and didn't pay that whole time, there's none of these tax consequences. And so this is something that I've had to come to grips with and strategize for. And so that's why I mainly focus on accumulating ETFs instead of distributing ETFs because of the tax implications. I think the amount of income one needs has to line up with the way they structure their portfolio. That's why, again, I don't want a high distribution in my portfolio. I don't want income from my portfolio because if I don't need it, I have to pay tax on it.
Right.
And then now I have to reinvest it. So this idea of reinvesting, it sounds great, but you're creating a taxable event every time.
Yeah.
And again, a lot of times we don't think about that. When we think about it, so it's okay, it's going back in. It's like, no, but the fund had to pay it out. We now have a tax obligation, and then we're reinvesting whatever's remaining. And so for myself, I want to be able to control exactly when I need money, how much I need. So I'm going to create my own income from my portfolio. And in my jurisdiction, that's going to allow for the best tax optimization. At least that's what the tax professionals have advised me of.
That's smart. Obviously, this is a prime example of how you've done your research, how you are continuing to educate yourself in making some of those decisions. One of the other questions, almost one of the last ones before we go to a quick rapid fire, and of course, a surprise question for sure coming up, is if you were to give yourself, your 19-year-old self, a piece of advice, what piece of financial advice would you give to yourself if you were to start all over again?
Well, I mentioned about the tax repercussions of a high churn rate in your portfolio. So some of the studies have shown there's 40% less total returns for people that have high churn rates and don't do tax planning. So I'd love to tell myself when I'm 19 years old, index, don't touch anything, because even if you outperform the market by 1 or 2 basis points, but you created a larger tax drag along the way, that 1 to 2% of outperformance actually puts you behind. I would have done better just because a lot of times we see indexing, oh, this is great. And then even indexers sometimes churn their portfolio so much that they keep having taxable events. And they're like, why don't I have the index return? It's like, well, because you had to pay taxes along the way. If you just kept it internalized and let it compound internally, you would have had that return minus, fees and maybe a little bit of taxes on the distributions. But if you turn your portfolio, so I wish I could go back and tell myself, invest in the market. The market is going to be up and to the right over our lifetime. If it's not, there's probably much bigger problems that we have in the world going on if the markets aren't as a whole up and to the right. And save yourself the time, spend more time with your friends, spend more time with your loved ones, and you're going to have more money at the end.
Super powerful and definitely something to live by. A few quick rapid fire questions, Mr. Financial. This may not be as easy because now you're fully in ETFs, but dividend growth stock that if you were still investing in dividend growth stock, you would never sell.
Well, like everyone, I would say, I wish I can go back and buy Apple and Microsoft before they started churning out a dividend. And I wish I just never would have sold them because, I would have been too young though. But even if I invested in the early 2000s, it would have been amazing. But again, I would still say no. Don't go that way. It creates too many problems. I would be watching it. Now's the time to get out now. Because getting out of some of these stocks, which I've had to do, is so hard. And that's why I've made a post recently about it. That's why I can't advocate for one I would hold on to, because it's so hard to time when to get out as well. It's so hard to time. We talk about, when to buy, but selling is one of the most difficult things you can do. It really is. And especially when you have to completely get out of it. So I can't say I wanted to buy something if I never want to sell something. So again, going back to it, broad market, index, ETF is the simple answer to that. That's the one thing I would never sell.
What is one book or resource that actually managed to change your investing mindset altogether?
It's funny, when you mention that, I've read a lot of books over time. And I think the one that's underappreciated and sometimes misused is The Black Swan. I guess it has a lot to do with statistics. A lot of people aren't interested in the math of it, but it really highlighted to me why I wouldn't want to be stock picking for my whole life. Because I'm young still, I'm only 40 years old. I'm hoping to have 40 to 50 more years in the market. And the probability of me successfully picking stocks for another 40 to 50 years, I may as well start buying lottery tickets, Mo. I really would. So that book really helped highlight how events happened in the world, besides not just with the stock market, events happen in the world that are just considered a black swan, and how they happen all the time and how you can never predict it. Like right now, we're talking about NVIDIA, how amazing it is, AI. We have no idea what's just around the corner and how AI could turn into telecoms. Telecoms were a hot thing, or could turn into the next Nokia, or can turn into the internet. Like, we talk about all these internet stocks that blew up in the year 2000. We don't know what the next black swan event, which is going to take everyone's attention and say, that's never going to happen, or this. Usually it's something that we could never even fathom happens. And it happens all the time. It happens much more frequently than we believe. And that, I would say, has something it's really stuck with me. It's an old book. It's a good book. If you like math, yeah, The Black Swan is definitely a good one.
I love that. And I haven't read that book, so definitely something to add to my reading list. What is one of the biggest, perhaps, investing mistakes that you had and you're comfortable enough sharing?
I've made so many mistakes. I'd say, like on Blossom Social, what you see, I made the mistake of spending a lot of time day trading. That creates stress. Yeah, I made some money. Could I have made just as much indexing? Probably. So again, like my time to benefit from my stress ratio.
Yeah.
So that was a good lesson. I've made some huge mistakes. Right? Yeah. I've also made some huge mistakes in individual picks because again, black swans happen, or you don't know what you don't know. And even internally, like I always say this, like when I talk to other stock pickers and we say like, oh, I know this company inside and out. And I'm like, even if you know it inside and out, I always say the CEO of a company doesn't understand exactly how his stock's going to perform and his company's going to perform. And usually you'll see it insiders, because if insiders knew NVIDIA, for example, was going to blow up like this, they would have all invested every single penny they had into the stock and they would be like, we're up this percentage, but they don't. And the reason why is because they don't know. How can I know? So I'd say I made some huge mistakes and over allocating too much, because when I would, especially as a stock picker, I used to have like a hard number. And then sometimes, because you get a little greedy, you up the percentage that you have in your portfolio of certain positions that should be satellites, and they almost turn into like core positions. And all it takes is one failure. That's what I always say. All it takes is one core holding to go under to mess up decades worth of work. And we talk about this a lot. You say, like, oh no, it's okay. I have like so much, my time horizon's so long. Like right now, if I blew up my portfolio, I'm going to be 80 to get to where I am now. Yeah. I don't want to do that. And I don't want to be working till I'm 80. So yeah, so there's, that's, I say, another big one. So picking wrong stocks, over allocating to stocks, day trading is a key lesson. Don't do it. High risk, low reward. We call it high risk, high reward. I always say it's actually high risk, low reward. There's huge tax implications. You're basically earning every single penny's taxable income. So you're at the highest tax rate, at least in Canada. I don't know what it's like in other jurisdictions or other places. That's another key lesson I've learned.
Are you a big fan of leverage or no? Do you try to stay away from it?
100% against leverage, because I always say, and like a lot of people, they're like, oh, I have a high risk tolerance. You always hear people talk about, I feel I have and it's no, you don't have a high risk tolerance usually. If you actually did and honestly answered a risk tolerance questionnaire, usually most people end up in like the middle zone when they're honest with themselves. And sometimes even towards the low zone, especially the older you get. Because for myself, when I was young, yeah, I had a high risk tolerance because I thought I could just lose it all. That's called gambling. It's called gambling. But for most people, they think they have a high risk tolerance, but they really just have a high desire for good returns. And they know that the higher risk they take, your curve is going to be getting really big. So you can have a huge loss and a huge gain. And so that's what entices people towards this high risk taking in the market.
I know, of course, you create content. Once you get to that retirement stage, Mr. Financial, do you see yourself continuing to make YouTube contents? And if YouTube was not the only thing you would do, what is one other area that you're very passionate about that you would love to pursue in your retirement?
Well, this is another hard question. I don't know if you could tell, I'm very passionate about finance, but I'm also passionate about food. I love my coffee. I love city planning. I love architecture. I love art. I have many areas of my life that I love, but it would probably be running a coffee shop. Something super chill, interacting with people every day, maybe tourists. That would be something that I would love to do.
That's amazing. That's so fantastic. I wasn't expecting to hear that, but that's super wonderful. We do have one final question, and thank you so much, Mr. Financial, for all your time today. This one is a surprise question, so I'm obviously not going to tell you who asked it, but it is actually from one of my previous guests, and they wouldn't know who they're asking this question to. And the question is, if you lost everything tomorrow, and had to start over, how would you rebuild your portfolio?
I would learn from you. I would XEQT and chill. And it wouldn't actually be that. It would be a construction of broad market index ETFs, definitely. But XEQT is great for Canadians if you like home bias.
That's amazing. Thank you so much, Mr. Financial. I feel honored. I definitely must say that you chose to come on my channel for this interview. For the longest while, I was always super inspired by your videos, loved the energy behind it. And I was like, oh, one day he should show his face. So I'm super glad that you actually did show that in one of your most recent videos on your channel. And I feel honored that I think this is probably the first time that you went on an interview after you showed your face. So it means a lot to me. And anytime when you comment on my videos or watch a video and share something, it means so much because I have so much respect for you, and really those comments coming from you, it has definitely a high caliber for me. So really appreciate all the kind words that you've shared with me. Definitely pushes me as well to become a better version of myself, to try to push myself. And even today, as we were talking about it, some of those aspects around the responsibilities that we have as content creators, folks that are putting content out there in the universe, definitely some lessons that I'm going to take away with me for sure. So thank you so much. All of that to say, for spending some quality time here with me and sharing your wisdom with me and the rest of my audience. I really appreciate that.
No, thank you for allowing me to have this privilege to speak to you like this in person.